Welcome to Swimming with Allocators. I'm Ernest Sweat, and each episode, Alexa Benz and I give you a VC podcast from the LP perspective. You ready? Let's dive in. On this week's episode of Swimming with Allocators, Alexa and I had the honor to speak with the Equity Alliance team, which is led by Claude Grunitzky and Adrienne Rees. It was such a great conversation, right, Alexa?
Talk about getting to ask some of those burning questions you've always wondered. Like, they told us what KPIs actually matter and which totally don't. Gave a really good defense of fund of funds, the math around that, if you can afford somebody like Adrienne, or you can't.
They probably can't, yeah.
And I also really appreciated their points on how do you identify emerging managers without a traditional track record.
So with that, let's jump in. So today on Swimming with the Allocators, we have the pleasure to speak with Claude Grunitzky, the CEO, and Adrienne Rees, the CIO of the Equity Alliance. We're really honored to have them because it's a great organization and that has an operation with a goal that I think everybody will be excited to hear. The Equity Alliance is a hybrid fund that invests in VC funds and startups founded by people of color and women. They have set out to deliver superior returns by investing in diverse managers and founders that the rest of the venture market has traditionally overlooked. And so with that, we're really excited to have both Claude and Adrienne here. Thanks, guys.
It's wonderful to be on this podcast, Swimming with the Allocators.
I'm glad you're a fan of the name. The perfect name I've always felt, even when talking to founders, is one that is polarizing, right? Either people like it or hate it, and so I think we're right in that. So we have one vote, Alexa, on liking it. Before we kind of get into the nitty gritty of what you guys are doing, I first wanted to ask just what's the story behind the Equity Alliance? How did it come together? And yeah, just want to kind of hear the origin story.
Yeah, it's a pretty interesting and I would say quite unusual story because the Equity Alliance is really the brainchild of Dick Parsons, our chairman and founder. Dick was having a conversation with his friend Kenny Lehrer, who is the founding managing partner at Lehrer Hippo, which is now New York's most active early stage VC fund. They were thinking, what could they do to bring equity to the space of VC? And they had this idea to start a fund, more on a fund of funds model, to back diverse, underrepresented managers. And Dick Parsons, I had known for close to 20 years. I had started building a relationship with him since he was the CEO and chairman of Time Warner. And at that time, I was a founder. I had been running my media company, Trace. And after I sold that media company, Trace, in 2010, I joked that I retired early in my late 30s. And Dick is somebody that I always wanted to work with. And I was always hoping that the call would come one day to work with Dick. And so he called me and he said, well, what if we started a fund to invest in women and people of color? Because I just don't like these inequities that I'm seeing in the VC space and in the broader kind of asset management industry. And so that's how we get started, with just an idea. And this was in 2021.
How did, that's in 2021, obviously, after a number of events like, George Floyd, BLM, and movements, there was a movement towards this. But how did that idea come from, go from an idea to actually okay, there's a strategy here and a strategy that's not crowded by other things. We can bring a differentiated perspective. How did you guys get to that point? And what did you see in the market at the time to just give you guys the confidence to say, okay, we have an idea and we need to create something new?
Well, initially, I was attracted to Dick's whole model of walking before we run. And he intentionally wanted to start with a smaller proof of concept fund one And a lot of people who were kind of big name financiers in New York were like, oh, your fund one should be $100 million given your track record and given Claude's track record. You should start a little bit bigger, given also the enthusiasm in the market at that time for bringing equity in this kind of post BLM, post George Floyd moment that had kind of started after George Floyd was martyred in May 2020. But Dick has one of the reasons he did so well in corporate America and rose to the top is because he always underpromised and over-delivered. And so we set out to raise $25 million for our fund one from a mix of institutional investors and high net worth individuals and family offices and foundations. And we were quite happy with the mix of investors that we were able to woo for our fund one. But I have to say that it could tell when we were raising that first fund that a lot of people were investing because they felt that they had to do something about the state of the market. And now that we are raising fund two, I find it to be a very difficult conversation from that 2021 moment.
This is a strategy based on sort of best practices. Can you give us an outline, maybe Adrienne, this is where you shine, on what this looks like in practice? Who are you looking to invest in as a fund of funds? And, what stands out with the managers you have selected?
Great. Yeah, at the Equity Alliance, we invest in diverse emerging managers. We believe that is where the greatest value still remains to be unlocked in venture capital. But if we took the traditional approach to diligence on managers, which is focused on MBAs from well-known business schools, track records, we would end up with a portfolio that looks very much like a traditional venture capital portfolio, which is disproportionately male and disproportionately white. And so while we diligence things like portfolio construction, we spend a lot of time really, really getting to know our managers. Our most recent investment took us over a year, and we thank them for their patience with us. But we really find that this is a business of people. We're investing in people, and we really want to get to know them and make sure that we make the right decisions in who we partner with, because we look to partner with managers for 2 to 3 fund cycles, which is a long relationship and a long partnership. And so really, I think there's 3 things that we look for that are most important in our decision process. And I think the first one is just really their why. Everyone in their decision process asks the question of, why does the world need another venture capital firm? But we, to Claude's point on social capital, take that to a little bit more of a personal level, because this is hard. And over the next couple of years, it's going to get harder. And the opportunity cost for almost anyone starting a firm in venture capital is really high. And so we really want to understand what drove you to decide to do this. Why spend the next 15, 20 years of your life building a venture capital firm? And it's somewhere it's going to take a long time before you see truly the fruits of your labor, 10 years at least. So I think really spending time with the manager, understanding why they've decided to do this is huge for us. And then really the first question we ask. And then secondly, what we call manager strategy fit, similar to what we talk about often in venture capital investing, a product market fit. But really, why do they choose the investment thesis that they're pursuing? Is there something in their background, something in their past that leads them to be the best person in this industry? And why have they chosen this specific industry? Say for at the moment, everyone says that they're investing in AI. What in their background actually says that they know something about AI, and why, how can they pick investments in this space? So I think that's key for us. There's been an explosion in the number of venture capital firms in the last couple of years, and not everyone's an expert in everything. So that's really the number 2 thing we look for. And then, as I mentioned, we invest in emerging diverse managers. And this is funds 1, fund 2, sometimes a fund 3. And a lot of the diverse managers that we're looking at don't come from the traditional backgrounds of finance. They didn't spend 20 years at one of the major VC firms and then spin out to just start their own firm. So some of the traditional indicators that LPs look at as to indicators of future success, it don't really exist for a lot of our managers. So we have to take a different approach into understanding, why are they going to be successful here? And if they don't have a traditional track record, which most of them don't, they typically have demonstrated success somewhere else in their careers, somewhere else in their lives. And for us, I think that's really important. When you were faced with a challenge, how did you react? Where did you achieve success elsewhere in your career? And we use that as a sign for what we think they'll be able to do here in venture. So I think really those are the key three things of really just understanding if this manager is going to be successful in what they do.
Like a couple grand slams, for instance. Serena Williams, she's got an okay track record.
Yeah, exactly. She's been successful in one or two things outside of venture capital.
Okay. Note to self: win a grand slam.
Yeah.
So you both brought up a couple things of threads that I kind of want to pull on, and so I think one is this idea of differentiation from different emerging managers and how they're able to present that, how they're able to present their like outlier potential of finding great companies. And then the other thing that was interesting was, Claude, you first brought it up, and then Adrienne, you spoke about it as well, was this social capital platform. And I wanted to know kind of like, how do those both work together in making sure that Equity Alliance not only finds the best emerging managers, but also helps support them? It's kind of like when I'm investing in a company, it's not only about like me finding a great company that has potential to scale. It's great, but the extra piece is if I'm able to contribute even a little bit to their success and getting that. And so how do you guys think about the two of those together, that sourcing, but then also essentially like platform management of your emerging managers and using the networks that your LPs and founders have?
Maybe I'll get started and Adrienne could add to it, because the first thing I'll say in answering the first part of your question, Ernest, is that I'm glad we're having this conversation now versus a year ago, because Adrienne brings a crispness and a rigor to these answers that I never had. And in a sense, things are a lot more process driven now than they used to be when I was kind of in the driver's seat for investments, because a lot of the decision was still very much driven by instinct and what the Nobel Prize winning economist Daniel Kahneman would call fast thinking. And so Adrienne is a lot more attuned to the new way of doing diligence. And that really complements some of my skill sets in that respect, because I knew instinctively that I felt that fintech and health tech would be two very important sectors for us, given the importance of new kind of financial outcomes and new kind of health outcomes for people who live in underserved communities in general. And so we leaned into that, again, driving just this boat with just pure instinct. And with respect to what I mentioned earlier about the social capital platform, we really call that our special sauce, because we're an alliance. We're not the Equity Alliance Ventures. We are an alliance because we aspire to be much more than just a venture fund that just writes checks. We have been able to bring to the alliance some of the people who are leading investors, financiers, CEOs, run major multinational companies. But we also have people who are strategic partners, who are educators, who are in industries that are just adjacent to the VC world as we know it. And because I've spent years and years building this network, and I'm relying on this is 5 decades of building this network, plus Adrienne's networks, plus everybody's aggregated networks, we say to our partners, as in the fund managers and the founders that we invest in, that if you engage with us, not only will you get financial resources, but you will also have this incredible resource in the form of a wide-ranging network of people who are engaged with us and can provide advice, can provide exposure to media and potential additional funding. And we can look these partners in the face and with a straight face say, well, no one else has such a broad and deep network. And I believe that that's how we can become an authority in the venture capital space, because we do much more than just write a check. Adrienne, I think you can add so much to that.
Yeah, I think I think your point on gut and trusting people is spot on as far as where we start, right? I think this is early stage. It's a people business. Really having that social capital and be able to build that trust is key. But we joke internally often that I started my career in investment banking, and the analyst who loves spreadsheets and me will never die. So we really started to build, processes around our diligence, around our portfolio analysis, and really understanding within the 23 funds we have in our portfolio to date, we have 525 underlying companies. So that's 525 underlying founders seeking to build companies, seeking to build funding, the majority of whom are diverse. And what we've really started to build is a system to track all of that. So we can see where there might be interest in another fund manager that we've backed in a portfolio company of one of our other fund managers, and really started to track the data at the underlying portfolio company level so that we can really use the social capital we have, the networks we have, to help every one of those founders and each one of our fund managers be successful. And I think really in the new age of, as I joked about AI previously, but in this age with really having our hands on the data and having our understanding of what's going on in our portfolio, what's going on in the portfolios of the managers we've backed, and who's being successful is really going to help us to connect the dots among our networks in a meaningful way, in a way that drives capital to the hands of diverse founders and diverse fund managers, and so that we all succeed, right? And that this tide that we're building raises all ships.
Now we're going to take a quick break to speak with our sponsor. From the co-founder and CEO of Passthrough, we have Tim Flannery. Passthrough makes fund closing simple for funds, administrators, lawyers, and investors. I'm just curious, where do you think venture is going to be in the next 10 years? Like, what do you see happening? Is there consolidation? Is there more distribution within certain regions? I'm just curious, where do you think it's going to end up?
Well, there's always going to be contraction and expansion, but overall, I think we're going to see an expansion in AUM, because the one driving force that's behind this is that products that have been primarily available to institutional investors have found their way to retail. This is true of public markets, whether it's ETF or derivatives that you can now trade on your phone when you used to have a stockbroker in the 1980s, as it is for alts. And so the alts model was pioneered by David Swensen back in the 80s for Yale. He took $1 billion endowment fund to something that's close to about $50 billion today. And the returns from that time have been fantastic. So something that was the endowment model, all the endowments adopted, then it became what all long-term allocators have started to do, which is find a space in my portfolio for alts. And venture is a major part of that portfolio construction. And so if you just take a look at the space from then till now, back in 99, the entire venture market was about $50 billion. We have venture firms that manage more than $50 billion today.
Yeah.
And I think this is still with, we still have this throttled too, because we have there's all these different managers who want to find ways to go build a retail strategy, but regulation doesn't allow them to do it. Technology doesn't allow them to do it. The demand is there for the managers. The demand is there on the ultra high net worth or high net worth or anybody in between. They'd like to go be able to participate. Right now, they're just prevented from doing so. And so my expectation is that the venture market will continue to grow, but now it's going to actually be able to grow in a way that's more consistent with underlying supply and demand. And so as we see regulations change, we've seen multiple things go up around changing accreditation status, around increasing the number of investors that are allowed into funds, et cetera. Well, then you also have tools like us that are going out to enable these kinds of things to occur. And so my expectation is that venture overall will continue to grow, and it'll continue to grow dramatically if you're looking over a 10-year time horizon. I do suspect we might have a bump or two in the road between here and there, though.
With that, do you think it will be the number of venture firms will dramatically change, going up or down in that expansion? Or do you have a view on that?
I would anticipate that firms contract and then expand and then contract and then expand. It feels cyclical to me.
Yeah.
Overall, I think the trend is expansion. When you're taking a look at all the different geographies that people are going to, all the different investment theses that people have, and the ability to then go out and market these products to retail. Yeah, I do think that it's going to overall turn to expansion, but we're going to have some ups and downs between them in terms of number of funds and fund managers.
Yeah, I definitely agree. From the LP dollars, as you mentioned, people having to expand where their reach is, right? Maybe they've been in more family offices, now they're going to institutionals and looking at, more, instead of fund of funds, looking at endowments and pension funds. Thanks to Tim and the Pass Through team. To find out how to give your LPs a better onboarding experience with Pass Through, go to passthrough.com/swimming. And now back to our LP interview. Adrienne, I wanted to, I was really excited to, have you on the podcast. Claude, you as well, obviously, as a Renaissance man. But I wanted to talk to Adrienne because of her experience of bringing kind of the investment banking, PE, LP, working at family offices like one of the Walton family members. So I just really appreciate kind of like your experience to date, and then where you see things are going. So one of the underlying questions I just kind of have is, why are you still interested in venture capital as an asset class with like such a flood of capital and noise? And then with that, where do you see the changes are going to come? Because it's my view that we're going to have some consolidation on all ends. And so, kind of where do you see things going, and how is that really um, influencing kind of the algorithm that you're playing in your head, and as far as the engine of Equity Alliance to be able to like find the real alpha?
Yeah, I think that's a great question. And I think specifically in my background of having spent a lot of my career in private equity and in M&A, I think it's a move you don't see very often into venture capital, because they are very different. And the diligence you do, the trends we have seen, at least over the last couple of years, have been very different. I always came to venture capital with my private equity investor hat, which I remember. The first VC deal I did, I showed up with my diligence question list of like a page and a half of questions. So like, who's going to answer these questions? And I thought that's what you're supposed to do. Um,
They're like,
you
what
know,
is this? Is this a new language? What is this? It's
yeah,
called profit. What is that?
yeah. What do you mean, like org docs? And we don't have a board of directors, so we can't give you the minutes. But I really try to keep my focus on that type of diligence, on that rigor. And I think over the last couple of years, as everyone saw, that the market just lost a bit of that. We lost discussion around cash, right? We've always said in the private equity world, cash is king, right? That's basic to any sort of accounting. And I think we lost that perspective a bit. And so now we're starting to see a little bit of a reversion to a focus on cash. You see, cash burn and runway showing up in pitch decks again. We see our managers focusing on that, which is something that's always been really important to me. Unit economics is a very basic principle, right, of any sort of company, is how is this company profitable from a unit economics perspective, and how does it scale, and how do we achieve operational leverage as the company grows. So I think we're starting to see a lot more of a focus again on those sort of basics of companies and on finance. And that's something that's a language I've always spoken, and it's a language I've always focused on. And I think we're seeing a reversion to that in the market now. Diligence processes are slowing down. I think we're seeing people starting to focus again on what really is going to drive these companies to be successful. And that doesn't mean that we don't focus on big ideas that can change the world, but we also focus on ideas that we think are practically feasible from a unit economics and basics perspective. So for me, I'm really happy to see that in this market. And I think we're seeing really a reversion to sanity. I think, to your point, I do think we're going to see consolidation in the market. I think that there were some tourist investors over the last few years. I think that there were some people that were able to get into this because they thought it was easy. And we're going to see that when companies start to fail in their portfolios, and when founders truly need that hands-on experience that everyone says that they have, and the interactions that they say that they have with their companies, do they actually have that? Are they really willing to step up to the plate and work hard with their founders? Are they willing to look their LPs in the face and have a hard discussion when things aren't going well? Because that's going to happen over the next couple of years. And I think we've done a great job of picking managers in our portfolio that are willing to do that are in it for the long haul. But that's hard. And I think we will see in this market some people that decide, hey, you know what, this isn't as fun as I thought it was going to be, and I don't want to do this. And I think that we will see some consolidation among those managers that decide, I think I'd rather go do something else. And I think that creates a significant opportunity. I think we have great managers in our portfolio. We're building a significant platform. I think we really see the opportunity here in the future of really just focusing on driving forward what are quality investments among women and people of color.
Alexa and Ernest, I wanted to maybe just add one thing, more of a personal anecdote to what Adrienne just said. One of the LPs who have been giving me what I've been calling an accelerated MBA in fund management told me really early on, and this gentleman is a co-founder of the Carlyle Group, right? So you can't get much more successful in the fund management business. He says, you'll be surprised because in 3 or 4 years, you'll see some of your fund managers walking away from their own funds. And that really reminded me of what you just said, Ernest, about the cream rising to the top. And we've kind of factored that in. We just know that not everyone's going to be successful. That's the nature of venture. But it's a very difficult business. So not everybody can deal with these tough times that we're in.
Yeah, it's real quick. It's really critical at this inflection point, in my view, in this industry, because as you mentioned, Adrienne, we had a lot of tourist LPs, tourist investors, and capital was, it's still always hard to fundraise, but it was relatively easy to get. And now things are coming up where it's like track record and it's not markups that matter. People want realized gains. And so that's going to make it even harder for people, like as far as a barrier to get in. But if you have conviction, whether you have that track record or not, I'm a believer in the persistence. I'm a believer that that cream will rise to the top. But we will see in these next, by the time we get to New Year's 2030, I think we're going to see a lot of different names, even if those with new fund names, but then also, with these top tier names, I think even the names inside, like the names on the back of the jerseys, will have to change.
Yeah, I agree with you. I think in a way that's a good thing though, right? I think it's one of the reasons we believe that the managers we back and some of the diverse founders that they back often are stronger, is that they've had to face greater diversity in getting to where they are. And I think to your point, who is left, the names on the jerseys and the year 2030 won't matter as much as the fact that like the ones that are still here are the ones that put in the work, the ones that really fought hard for where they are. And I think we're going to see a significant increase in overall quality within the venture capital industry in the next several of years as well.
Yeah, it's an interesting, it really puts the pressure on that if you already are facing bias as somebody out there fundraising, it's really going to come down to results. Do you have any advice for LPs who are listening, who are sort of nodding their heads saying, oh, this thesis makes a lot of sense. Diverse managers are going to be investing in things that I don't necessarily see that are really big opportunities. Any advice for these LPs who maybe aren't taking a lot of meetings with female or Black or brown emerging managers?
I would have advice, and I'm sure Adrienne does as well. Somebody who talks to LPs every single day, I would say that they should avoid, again, I have to go back to Daniel Kahneman because I have a bit of an obsession with him. Avoid the availability bias. What is that? It means that they'll lead with whatever is the last thing they read in the Wall Street Journal or whatever is the last thing they saw on CNBC with respect to venture. And I meet with them, and these days, everyone wants to ask me about AI and how do we feel about AI? What is our investment in AI? And I want to invest in AI. And as somebody who, I went to MIT, so a lot of my friends are in that space. My cousin, who's like my brother, has been working in AI for 10 years. He's on the leadership team for Alexa for Amazon. So every time I talk to him, we talk about AI for a while. And I know that there's a lot of people who don't know what they're doing. and a lot of people are going to lose their shirt by just jumping on the AI bandwagon. And as a result, I just would like some of these LPs to not be victims to the herd mentality. And in the same way that a couple years ago, those same people, by the way, were asking me about Web3 and crypto and what's your position on that. It's like, please just give us time to identify the very, very best practitioners, people who really know what they're doing, really suited to be winners in this game, as opposed to all these fly-by-nights who end up changing their pitch decks and adding AI to the first page, thinking that that's what's going to actually get them more capital.
Yeah, I think what I would add to that is that, amazingly, some of the LPs we talk to still have yet to make an investment in a fund led by a person of color. And these tend to be large institutional LPs. And the challenge that we really see for them, one, is primarily that their check sizes are quite large. And just given where the market is for women and people of color in venture capital right now, is that the amount of capital they're able to raise is generally on the smaller side. And given the portfolio construction that you're able to build with a smaller fund size, typically very early stage venture capital, so that you can build the diversification in the portfolio that you need. And so emerging managers early stage tends to result in, a greater dispersion of returns. And if you're an institutional investor, therefore, you need to also build a diverse portfolio. So you need to make investments in several of these managers and build really a diverse quality portfolio of diverse emerging managers. And that is hard and it's resource intensive. And if you don't have the networks and you're not willing to deploy the resources internally to build these diverse portfolios, then I think you're better off with a strategy like the Equity Alliance, like a fund of funds, because we have those networks and we have built the connections, we have the diligence processes in place to truly evaluate and build a diverse portfolio. And I think that is where a lot of institutional LPs struggle with writing a first check into a diverse emerging manager, is that you need to do several of them and really build this portfolio and truly be focused on it. And so I think if you're not willing to do that internally, picking a strategy like a fund of funds is a better move for an institutional LP. But there tends to be still a bit of an aversion to the fund of funds model. I think there was an article in the Wall Street Journal in 2009, right, where the head of the Yale endowment said something about like funds are terrible investments or something. And I think that's really just a focus on the fees on fees. And we always get that. We always get the response of fees on fees. And the reality is, if you really look at the numbers of what this would cost you to do internally, it is significantly higher than the fees you would pay a fund manager that's investing in other funds. So, I'd also give LPs the advice to really run the math. I'm, again, a numbers person, and run the math of what this truly costs you to do internally to build a quality portfolio of diverse emerging managers versus a management fee for a fund of fund strategy like ours, because it's higher than they think.
Yeah, you can't afford, Adrienne, to be on your team. Oh, Claude already swooped her.
I also wanted to ask you all from our kind of other audience, from the VC, both those that are emerging managers, as well as, given we're going to have a lot of generational change over the next 10 years, those GPs that are going to be stepping up and doing more fundraising. Just curious, what are the just easy don'ts that you can avoid with when talking to LPs? Like, what advice do you have for those managers?
I think for us, the biggest thing is one of our core values here at the Equity Alliance, right, is authenticity. So I think people that come in pretending to be something else, something that they're not, and putting on a face, it's easy to see through. I think really showing up with authenticity and showing up with bringing what you really have to the table is the best way to approach LPs, right? They're people too. So people talking to people, I think showing up with a lack of authenticity is probably the key don't. I think it's much more transparent than people think. Claude always gives the example that they often reference I know these people and this person and that person, and we do too, and we'll call them, and we will know quickly if you really have that relationship. So I think just being authentic and and transparent is really the key.
Just wanted to say thank you all for taking time out of your busy day. Really appreciate Adrienne and Claude.
Thank you all so much.
Super fun.
See you later, allocator.
After Portfolio Tile, investing with a smile.